You ever get the feeling the economy is just sending totally mixed signals? Well, that's exactly what it's like in stage one of the economic cycle. We're calling it the underappreciated turn. This is the kind of recovery that sneaks up on you, the one that starts in silence while everyone's still looking over their shoulder, bracing for the last storm.
And this, right here, is the central puzzle of stage one. You start seeing these little green shoots in the data, real productivity gains, but the overall mood? It's just sour. The headlines are still negative, and every conversation is filled with caution. So what gives? Why is there such a huge disconnect?
Okay, here's a good way to think about it. Imagine the economy is a patient recovering from a really long, tough illness. Internally, things are getting better, the vital signs are improving, strength is returning, but the family, and in this analogy, the market is the family, they're still treating the patient like they're on their deathbed because they're just so conditioned by the crisis they all just lived through. That's the lag we're talking about. And this really lays out the two competing stories, side by side. On one hand, you have the market, which is totally stuck in the past. It's just dominated by pessimism, apprehension, and fear. But on the other hand, the actual economic reality is one of quiet, steady progress. A real foundation for growth is being built right under everyone's noses. So what is behind this massive gap between perception and reality? Well, it pretty much all comes down to how our brains are wired. Let's dive into the psychology that makes us, completely miss this critical turning point. First up, we've got something called recency bias. It's kind of like when you have one terrible meal at your favorite restaurant and you swear, that's it, I'm never going back, even if they've since hired a world-class chef. We let our most recent, most painful experiences completely color our view of the future, and it makes it almost impossible to believe things are actually getting better. And then you've got its very powerful partner in crime, loss aversion. The short version is this: we absolutely hate losing way, way more than we love winning. This deep-seated fear of taking another hit makes everyone, from individual investors to the big institutions, just play it super safe, even when really good reasons to take a calculated risk are starting to pop up. Yeah, this 2x number is a really big deal. It basically means our brains are hardwired to be about twice as motivated to avoid losing a dollar as we are to go out and gain a dollar. That powerful fear creates total paralysis, and it's exactly why so much capital just sits on the sidelines during one of these quiet recoveries. So you put these two powerful biases together, recency bias and loss aversion, and what do you get? You get this sentiment lag. The market is basically driving while looking in the rearview mirror, obsessed with the crash that just happened, while the real economy is already cruising forward down a brand new road. But here's the thing. While the market is moping around, something real and tangible is happening right beneath the surface. Let's actually look at the signs of this genuine, sustainable recovery that's starting to take hold. This quote just nails it. The growth that's happening here isn't some speculative frenzy. It's not a party fueled by cheap debt and easy credit. No, this is the real deal. It's sustainable progress built on the solid foundation of companies getting more efficient and making much, much smarter decisions. So what's driving all this disciplined growth? Well, surprisingly, it's often the high interest rates that are left over from the last cycle's fight against inflation. See, high rates act like a natural filter. They weed out the weak ideas, the half-baked projects, and they force companies to focus only on investments that are actually going to work. This kicks off a powerful, virtuous cycle of strong, sustainable growth. It's simple, right? When money isn't cheap and easy, you don't waste it. Capital gets pointed with laser-like focus toward real innovation, real productivity improvements, not just thrown at speculative bets. And that's why this period is so critical. It's when real, lasting economic value gets created. Okay, so we've got a pessimistic market on one side and a quietly healing economy on the other. This setup creates a huge opportunity for a very specific type of investing. So how do you play it? Well, the smart money knows exactly what to do. Let's break down their playbook. You can really see the two different mindsets in this stage. The speculative investor, they're just sitting on the sidelines, waiting for the party to start again, looking for hype and optimism to come back. But the value investor, they're already hard at work, shopping for bargains. They're buying up solid companies that are fundamentally strong, but are just completely unloved by the market right now. So the winning play here is what we call a flight to quality and valuation.
You're not buying a story about what a company might do in the future. You're buying what a company is actually worth today, based on its real assets and real earnings, not what the market just hopes it'll be worth tomorrow.
And here's your checklist. You're looking for solid, maybe even kind of boring businesses that have rock solid balance sheets. These are the survivors. They're the ones that got unfairly punished when the whole market went down. And now they're just sitting there, available at a deep discount to their true inherent worth. So, how can you actually spot this quiet recovery out in the wild? It turns out there's a kind of secret signal hidden in the data that can tip you off when it's happening. So, let's decode it. It's called the index to commodity ratio, and the best way to think about it is as a tug of war. On one side of the rope, you have Wall Street's hopes and speculative optimism, which is represented by a stock market index. And on the other side, you have Main Street's actual needs, real economic consumption, represented by commodities, the raw materials the economy actually uses. Now, listen close because here's the tricky part that almost everyone misses. In stage one, a flat or even a falling ratio is actually really good news. It's a positive sign. It tells you that speculation is lagging, but real consumption is quietly growing. It's the signature of hard-earned growth, not some flimsy, sentiment-driven rally. So, this is the crucial takeaway. Don't mistake a flat or falling ratio for a red flag. In the specific stage of the cycle, it's a giant green light. It's a leading indicator that a genuine organic recovery, one built on actual substance, not just hype, is well on its way. And that really brings us to the final question you've got to ask yourself. When you look at the market, are you just listening to the noise from the headlines and the crowd, which is almost always late to the party? Or are you looking deeper for the clues hidden in the foundation? Because that quiet recovery, it's happening, whether everyone sees it yet or not.